In the early 1990s, the nations of Southeast Asia and South Korea were operating at a blistering pace. Their economies were expanding by an average of 7% year after year. Governments across the region ran strict fiscal surpluses while keeping inflation tightly under control. Combining high domestic savings with massive economic expansion turned these markets into primary targets for global investment funds and major commercial banks looking for high-yield returns. Then, on July 2, 1997, that stability completely unraveled. Over the next few months, local currencies went into a rapid freefall, with the Indonesian rupiah ultimately losing a staggering 83% of its value. To see exactly how fast the markets broke down, look at this chart tracking a $1,000 investment in the South Korean stock market starting in June 1997. Within exactly 12 months, that same position shrank to just $290. These countries had perfect public data, healthy government accounts, and the total confidence of the global banking sector. We need to look at how an economic engine with such a pristine exterior managed to conceal a fragile, catastrophic debt bomb from the top financial analysts in the world. The origins of this collapse actually trace back to the United States following the 1991 recession. To stimulate a sluggish domestic economy, the U.S. Federal Reserve aggressively slashed interest rates. Because American yields were suddenly so low, international capital immediately left the U.S. in search of better returns. That cash poured directly into the high-growth markets of Southeast Asia and South Korea. This sudden influx of cheap capital created intense upward pressure on asset prices. Local markets had more money than they knew what to do with, leading to massive overcapacity in the export sector and unchecked investment into real estate and public works projects that lacked any realistic path to profitability. Regional economic expansion had decoupled from local productivity or genuine demand. Instead, growth relied entirely on a continuous pipeline of cheap foreign credit. To attract and reassure those foreign investors, Asian governments used a mechanism called a currency peg. They artificially locked their local money to the US dollar by a fixed exchange rate, guaranteeing absolute stability for anyone looking to invest. But eventually, the American economy recovered. Under Chairman Alan Greenspan, the Federal Reserve began raising interest rates again, which caused the US dollar to quickly strengthen against other major global currencies. As you can see in this visualization, the strict currency peg meant that as the US dollar rose in value, the Asian currencies were dragged up right alongside it. Because their money was suddenly more expensive, South Korea and Southeast Asia rapidly lost their competitive edge in exports. A problem worsened after China drastically devalued the yuan. With their main source of income, exports, slowing down, a massive gap opened between what these countries were earning and what they were spending. To keep up the appearance of rapid growth and finance this deficit, they began borrowing billions from abroad. By 1996, the accumulation of this offshore borrowing reached severe levels. Notice how this red foreign debt column aggressively scales up and dwarfs the actual gross domestic product, eventually exceeding a massive 165%. The fixed exchange rate had transformed from a tool for stability into an economic trap. These nations were now financing an illusion of prosperity using entirely unsustainable levels of foreign debt. The pressure point finally snapped in Thailand. Back in 1993, the Thai government aggressively deregulated its capital markets, offering tax incentives to build an entire international financial center in Bangkok, meant to compete with Hong Kong and Singapore. Thai banks specialized in foreign exchange lending. They borrowed massive amounts of capital denominated in major international currencies, specifically the dollar, and then channeled those funds into local, baht-denominated real estate projects that had little chance of ever turning a profit. Predictably, between 15 and 24% of these loans began defaulting. But thanks to lax regulation, banks simply refinanced the bad debt without classifying it as doubtful. They even counted uncollected interest as revenue, falsely inflating their profits so they could continue paying out massive executive bonuses. By early 1997, the financial institutions completely ran out of cash. To prevent a panic, the Central Bank of Thailand began secretly injecting liquidity into the failing banks, rapidly burning through the country's own international reserves to keep them afloat. Eventually, those reserves ran out. On July 2nd, the Thai government was forced to announce the end of the fixed parity with the US dollar. Without the peg to protect it, the baht's value instantly collapsed. The math made survival impossible. The banks held assets in a rapidly depreciating local currency, but owed billions in high-value US dollars. The entire financial system was dead on arrival. When Thailand's banking sector imploded, international depositors panicked. They quickly realized that if the Thai government's pristine public data had been hiding rampant insolvency, neighboring countries with identical economic models were likely concealing the exact same rot. Foreign credit lines instantly vanished. Between 1996 and 1997, the region suffered a massive $112 billion swing in capital flows, a sudden withdrawal of credit that instantly broke the banking systems of South Korea, Indonesia, Malaysia, and the Philippines. The failure of the financial system immediately paralyzed the real economy. Thousands of businesses shuttered overnight, and within a single year, Indonesia's total economic output contracted by more than 13%. The collapse in production triggered immediate, widespread layoffs. Millions of citizens who had spent a decade building middle-class lives were suddenly unemployed, leading to massive protests demanding a solution to the immediate monetary crisis. To prevent total sovereign default and force the structural reforms necessary to stop the bleeding, the affected nations ultimately required an immense $120 billion wave of international bailouts, heavily coordinated by the IMF. The 1997 crash demonstrates exactly how fast wealth can evaporate. Pristine macroeconomic indicators like high GDP growth and fiscal surpluses offer no protection when the foundation underneath relies on unchecked foreign debt, rigid currency manipulation, and deeply hidden localized financial rot.